The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
A historically tough month for stocks starts off exactly as history suggested. From Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostick, and welcome back.
Oh, thank you very much.
Yeah.
Not so much for the markets, though.
Yeah, you should have come back yesterday.
Yeah,
nothing was happening.
That would have been a lot better. It is a brutal day out there, guys, within the market. It's a pure safe haven trade. We haven't seen this kind of decline for the S&P since that horrible August slide. You're looking at S&P right around the lows of the session, down 2%. And it's a typical safety trade, right? Dollar yen down as the yen gets a nice bid. You have buying all across the Treasury curve, in particular in the back end, and volatility spikes as well. Remain not only is September usually bad for stocks, but it's also usually high for volatility. And as you said, we are definitely seeing that play out today.
And we should have seen this coming. Remember, U.S. equities led net selling across the board in the last week as hedge funds really trimmed those long positions. And the net effect of that really did break down the door into this new week and, of course, the new month. The Stock Traders Almanac showing that September has been the biggest percentage loser for the S&P and Dow since 1950. And with stocks coming out of August near those redonkulous record highs, there's a bearish skew heading into that payrolls report this Friday.
But I think that the equity markets today are asymmetrically skewed to the downside, at least over the near term at these current price levels. So I think the market is going to really focus on the bad news right now. So bad news is really, really bad news. And that is probably what creates the correction that I think is going to occur in September.
Well, that's the story for stocks. Meanwhile, after an encouraging start to the summer for commodities, traders are turning tail. Copper on a 3-month rolling basis down for a fifth session. Crude oil slumping to the lowest levels of the year. Tepid consumption, increased supply, partly to blame. All that agitated by algorithmic oil traders who are exacerbating that bearishness. A conversation in just a moment with commodities veteran Jeff Currie. Meanwhile, well, the head of fixed income over at T. Rowe Price, who last year called Japanese monetary policy the San Andreas fault of global finance, is now warning that volatility that upended the yen carry trade last month and, of course, hit global stocks, that was just the beginning. The yen, which rallied 9% in July and August versus the dollar, today advancing an additional 1%. That's following some hawkish remarks, Alex, by the governor over at the Bank of Japan.
It does feel a little bit like a redux like we saw back in August. And here's another way of looking at what Romaine and I have just been talking about, S&P's worst day since that August meltdown. You can just see here the decline down 2%. Haven't seen that since we got that jobs number back in August. And now the question is sort of, where do we go from here? Is this going to be how the month of September is and volatility picks up and we get jobs data on Friday? The manufacturing data today was no help at all for the market. It was definitely weak across the board. Hard to find a trough there and some real stabilization. Demand very weak. I was talking to Tim Fiore of the ISM manufacturing indices, Romaine, and he was saying that, look, companies and customers are now on hold until after the election. So is this now what we can expect until November?
Yeah, and things are getting worse as you speak, Alex. Stocks hitting session lows. A lot of concern right now as to whether this is just a one-day blip or the start of something new. Bloomberg Intelligence's Chris Cain joining us right now to kick us off to the close here on this Tuesday afternoon. And wishing we have you here under better circumstances, Chris. But it's kind of weird. I mean, we kind of forget that right at the end of August, I think it was August 30th, you had an S&P 500 that was 20 points away from reclaiming its record high. And now here we sit on a day where it's down 2% and the NASDAQ Composite Index down 3%.
Yeah, it's been a bit of a defensive nature to the market for a while now. It's kind of, when you look at the index as a whole, and like you said, it was right at all-time highs a couple of days ago. It's not far from all-time highs now. So bigger picture, is still strong. But when you look under the hood, there has been some defensive stuff. So I'll give you some examples. Like in August, the best performing sectors were all the defensive sectors, things like healthcare, things like consumer staples, things like real estate. Mm-hmm. The lagging sectors were the more cyclical stuff, things like tech, the consumer discretionary. When you look at even the recovery of stocks over the latter half of last month, it was like every riskier index underperformed the more defensive index. So things like small caps underperformed large caps. Things like emerging markets underperformed developed markets. And even under the hood on the individual stock level, the factors that worked the best were the defensive factors. So Things like low volatility stocks beat high volatility stocks by roughly 4% last month. They're up another 2% today on a relative basis. High quality beat low quality by a similar amount. Those are factors where people run when they're a little bit defensive. So while the market was going up on an index level, there was some defensiveness under the hood.
What we didn't see in August was a spread to other parts of the market. You had that spike in the VIX and the decline in the equity market didn't spread to the corporate bond market very much. Are we seeing that now?
Not yet. So corporate bond spreads are still, they're out today, as you would imagine, on this volatile day. But on a relative basis, they're still very low. Like we looked at the relationship between equity volatility as measured by the VIX and corporate bond spreads. What you find there is a very positive relationship, which makes a lot of sense. But that data point a couple Mondays ago, early August, was a huge outlier where you had very high equity volatility, but very low corporate bond spreads. Our takeaway from that is that, this isn't maybe a quote unquote real economic problem. It's more like a technical problem going forward.
So the question is, what changes this, if anything, arrested here? I mean, is this really about waiting for a different fundamental picture or what?
Well, I mean, let's just say it's one day, right? This is one day, again, we're near all-time highs. I know it feels bad today. But I would say generally, the earnings picture is very strong. And if you want a fundamental reason why this market goes up, it will be that. Like, I'll give you some numbers. The expectations for year-over-year EPS growth coming into this quarter was about 8%. It actually did 14%, almost double. And that's very broad-based as well. If you look at what we call the other 493, so the ex-Mag 7 stocks, they were expected to grow earnings at about 4%. They came in over double at 9%. Over 80% of the stocks that reported beat their EPS expectations. So earnings season was very, very strong and should be a tailwind going forward towards the end of the year.
All right, one of the best in the business, Chris Cain over at Bloomberg Intelligence. Alex, as we continue to watch stocks right now around session lows.
And around session lows is also what we're seeing within the commodity market as well. Oil getting slammed. That is similar to what we saw back on August 5th. Joining us now for more is Jeff Currie, Chief Strategy Officer of Energy Pathways over at Carlyle. Jeff, it's such a pleasure. Thank you so much for staying up late for us. What does $70 WTI say to you about global growth?
It'll definitely stimulate it relative to 85, 90. But I think, yes, you're right. It did sell off based upon concerns around China. But the data disappointment was a PMI that was expected to be 49.5 and came out at 49.1. Does that justify the oil market being at a record short? Absolutely not. No, I'm not going to argue Chinese demand growth is robust in any shape or form. And yes, they have structural problems on the longer term outlook. But by all means, it's not a collapse that would justify the market being as short today as it was in the global financial crisis of 08. So you got to ask, what's going on here? It's something far deeper than a slowdown in China. Because when you look at this market fundamentally, inventories are low. The forward curve today, even after the sell-off, is backwardated, and a very high level of backwardation, which is consistent with a very tight, fundamentally strong market. And then the third issue is concerns around OPEC bringing on supply. They're bringing on a small amount that is being completely compensated for by decreases out of Kazakhstan as well as Iraq. And given the credibility of OPEC recently, it's going to be important that credibility is maintained. So I think these fears need to be put in the context of what the physical market looks like, which is relatively robust.
I'm curious, Jeff. I mean, as everyone tries to read these economic tea leaves, obviously oil sends a signal, or at least they think it sends a signal. Also, people are trying to look for those signals coming out of copper, and we're seeing a lot of weakness there for a fifth straight session here. We're a far cry from those days when people were calling for 10,000 or even 15,000, as one person called it. Maybe we get there long term, but I wanted you to talk more about the near term as to exactly what's ailing that copper trade.
Well, I think you had two dynamics in China. One, you had a very weak property market, and when everybody was bullish on copper going back in May, the offsetting force was that strong green capex. So China was subsidizing and beefing up the green capex investment, EVs, solar panels, lithium batteries. And that strength was keeping strength in copper demand, offsetting the weakness in the property demand. What has happened since then? The U.S. as well as Europe have responded with tariffs on some of these EV goods, slowing down that engine of growth for China. And at the same time, the policy focused at propping up the property market has, not come through as strongly as many people have thought. And so that weakness in the property market is currently dominating. So what does that mean to copper prices? It still has a floor based upon that strong structural supply story, but it has a cap on the upside based upon that weakness in demand. I would say, 8,500 type on the bottom, 9,500 on the top, until we start to see the policy begin to create some strength in China. But I want to emphasize, China is not unraveling like a global financial crisis situation in any shape or form. You look at, WeChat Pay numbers, it shows consumption up about 1%. And yes, oil demand was a little bit weaker than what the economics would suggest, because you have trucks switching to LNG from diesel. But that's structural, that's priced in the market. So I want to emphasize, yes, it's weak, but it's nothing like the positioning.
So let's get to the positioning part. You had a really interesting note out last week, Jeff, that talked about how oil being used in essence as a carry trade. I'm going to pull a little quote from your piece. You say, with the rate cycle likely peaking given recent data, we will see that the borrowing cost for oil will be relatively more expensive. And then you go on to say, hold on, let me pull it up here, forcing an unwind like it did with the yen, which has likely caused fear short covering from both the financial and physical markets. Basically, you're saying, look, what you're seeing in the market is that oil has been used to buy other stuff. And when that unwinds, that's going to be a sharp spike up. What do you see that everyone else is missing?
You see this not only in oil, but some of the other more capital-intensive industries. Oil is more volatile than most of the other sectors, so it has an extra cost to holding it. We estimate that to hold oil with a risk-free return of 5.25%, which is where the money markets are paying you right now, you need a return in excess of 14.25%, call it 15%. A 15% price move at a $75 price level means somewhere around, $10 or $11 a barrel. And then, so your expectations have to be for a big upward move before you're going to own it. Now with the sell-off down to 73 on a Brent basis, the probability of seeing that upside is now much more likely. You're probably going to see investors pull money out of the money markets and put it back into oil. But when I talk about the borrowing costs in being short oil, essentially by drawing down your inventories to very low levels, you're leaving yourself very exposed to being short if something were to happen, like a demand surprise to the upside or some type of supply shock. Then the physical guys would have to come in, cover that short, which means increase the demand for the physical barrels. And then you look at the paper inventories, call it working capital of physical oil, working capital of financial oil. They're also short the financial oil. And so when we look at the market today, you have record shorts against really low inventories. That historically doesn't happen. The only explanation for that is people are taking money out of this market, taking working capital out of this market and putting it into higher returning endeavors. What? Now with the pullback, you're likely to see some of that money come back in. Yeah. You'll race back up. Part of the reason why we've seen the market go from, 73 up to like 92, back to 73, up to 92 is the investors got to be pretty comfortable they see a return in the oil market that's greater than what they can see elsewhere.
So what So what happens, Jeff, in a couple of weeks' time when the Fed, as most people presume, begins to cut rates? Does that change that trade?
Well, I think there's a orderly unwind and a disorderly unwind. The Fed cut is expected. If they were to be much greater or something like that, it's probably going to be a very orderly process as we move back to lower risk-free rates of return, or think about the cost of capital holding oil in the financial as well as the physical, where that's going to begin to unwind. Here's another point, too, is that the Fed is a global central bank with a local mandate, meaning its policy affects the world. In many of those places like China, Europe, Japan, they're very capital intensive. And as the U.S. lowers the rates and lowers that cost of capital for a lot of those capital intensive sectors around the world, there's going to be a lot more leverage in those parts of the world where you're going to see the uptick. And oil is in particular one of those industries that's very capital intensive and very global in nature. So you should start to see a stronger improvement in the oil market than you would see in other sectors.
You also write in your note, Jeff, how this circles back to the U.S. fiscal deficit. How does it do that?
Because when we think about the fiscal deficit at 7%, it's near, it's a record peacetime non-recessionary fiscal deficit. That means when the Fed had to raise rates to slow down growth, they had to raise it a lot higher because it was going against that 7% fiscal deficit. So the interest rates got too high for the rest of the world, particularly the oil industry, slowing it down. And you think about OPEC, it was responding to that weakness it was seeing globally because of those pressures. And again, when we think about as they lower rates, that leverage to the other part of the world will begin to increase and allow OPEC to be able to put those barrels on the market.
Interesting.
All right, Jeff, got to leave it there. Great to talk to you. Great to catch up. Jeff Currie, he's now the Chief Strategy Officer over at Energy Pathways at Carlyle. A lot more coming up here on the big program, a conversation about those imminent rate cuts and how it could separate Redfin from its real estate competition. We're going to talk about why that stock is bucking today's sell-off.
All right, plus our short reports squashing tech with the Mag 7 slumping along with the rest of the market. We're going to look at where tech could go in 2024.
And we're going to take a closer look at Boeing. Another bad day, another bad headline. The company now tracking under a $100 billion market capitalization for the first time in a long time. We're going to talk about what's next for the embattled aerospace giant. All that and more coming up in a bit. This is The Close on Bloomberg. Time now for our top calls, the big movers on the back of analyst recommendations. And we start off today with Alphabet. Morgan Stanley cutting its price target to $190 from $205. And while the analyst is keeping his overweight recommendation, he sees uncertainty over the possible antitrust scrutiny from the Justice Department here in the U.S. He says near-term headlines could pressure Alphabet tactically, especially if some of the DOJ's proposals are severe. Those shares down about 4%. Next up, let's take a trip to Sin City. James Dolan's Sphere Entertainment cut to sell at benchmark. The analyst saying creating content for the Sphere is expensive, and once the weaker consumer environment of Las Vegas is factored in, investors should brace for a potentially underwhelming profitability outlook. Those shares down 3.5%. And finally, Redfin, an upgrade to buy over at B. Riley. The analyst saying he's impressed with the real estate brokerage's business fundamentals. And once interest rates come down in the next few months, transactions volumes should actually increase. Those shares bucking the sell-off today, up about 1%, and those are some of our top calls. Joining us right now is the man behind that call, Naved Khan, Managing Director and Senior Research Analyst over at B. Riley Securities. Look, is this all just an interest rate story?
Look, I think it's a combination of things that come together. So interest rates are going to be part of it, because as we head into a lower rate environment, that's conducive to real estate transactions, and it just provides a better, more conducive macro backdrop. I think the bigger story is really in what the company has done to its own business, right? So they are in the process of moving to lower fixed cost model in the brokerage business. That's the core of the company, and what it would allow them to do is therefore operate with sort of a leaner structure, cost structure, deliver more consistent margin profile. And that combined with some of the other things that are happening, such as product attached, they can drive with mortgage origination, with the title business. And they've also added a rental business over the last 2 years. So all of that combined, I think, with the fact that the macro is going to turn more favorable, make this an attractive name to own over the next 12 months, I want to say.
You think it's an attractive name to own relative to its competitors, its peers, like Zillow and others?
So I do not cover Zillow, and I've covered the company in the past, so I can tell you that Zillow is a play mostly on the advertising business. They also have a rental business. They are not a real estate brokerage company. Redfin is an online real estate business.
Yeah, they kind of do it all at the end of the day. Naved, do you think that when we do see rates coming down, there's going to be more buying, or is it going to be a lot of refinancing? How do you think they're going to benefit?
So I think it's going to be both, but where they play is mostly in the home transaction space, so more from home purchases. So I think that's been a friction point because people got used to a low rate environment where you could get a mortgage sometimes for under 3%, a 30-year fix, right? And then here we are where interest rates have gone up quite a bit. Mortgage could cost you like 6.5% in terms of annual rate. So as we move down, and it really is a question on how much we're going to move down, but you can look at consensus estimates out there. But as we move down, I think that will make taking out loans more affordable, and therefore improve the affordability of home buying, which is positive for transaction growth.
How much do brokers make when they're attached to Redfin? Like what's that side of the business, and how does that work for Redfin?
So Redfin has a sell side and a buy side. If you list a home for sale through Redfin, you could be paying from 1 to 1.5% in terms of broker fee. And if you engage a Redfin agent for a home purchase, then it's something that you, as a home buyer and Redfin agent would mutually agree before you start the transaction. It used to be, not too long ago that you could be a home buyer and you would engage with a broker and not even ask about what kind of commission they would charge because the buyer always thought the commission was paid for by the seller, and it was kind of an all-inclusive price that was paid. Now I think that's been kind of that has evolved, and I think it still is evolving.
We'll talk about that continued evolution and look a little bit more long term, because there has been a lot of discussion about how those changes. I don't want to say it's going to sort of make it obsolete, but this idea here that if those commissions come down, maybe even to the point where it forces a lot of real estate brokers out of the equation and empowers more people to list their homes themselves, does that benefit a platform like Redfin?
So Redfin has kind of multiple offerings. I want to say they also are experimenting with a direct listing, where if you are a homeowner and you want to sell your home, you could list on Redfin for a fee. They're testing that. There is another offering that they have, which is the standard. You can engage with their broker, and if you sign on the dotted line that you agree with the Redfin broker, they would be willing to give you a credit, which is funded by the commission. So they would give you a 25 basis point or 0.25%. Think of it like a cashback from the transaction. So they are therefore incentivizing a home buyer to work with their agents versus somebody else.
All right, Naved, we really appreciate it. Thanks a lot. Again, a stock in the green when everything else feels like it's in the red. Naved Khan over at B. Riley Securities. Thank you very much. Just take a look at the market here. You got the Nasdaq now down by about 3%. Romain, you got the S&P off by 2. The Dow is off by 1.5 on very heavy volume.
Very heavy volume. And of course, you take a look. I don't know if you have it there on the screen. There's your 10-year yield there, because you're also seeing, of course, a lot of buying in the Treasury space. That's, of course, pushing yields lower here on the day, about 6 basis points on that benchmark 10-year. You have a VIX back to that 20 level. And of course, we were just talking with Jeff Currie about some of the daily moves that we're seeing in commodities. Crude down. Had their first settlement on Brent below 75, I think going back to December. WTI settling right around 70.
To his point, though, I was looking at the curve. You can look at it for CCRV on the terminal, and we are still backwardated. So those prices today are a lot higher than prices in the future, and that has increased. So that would imply more demand than supply. So just to keep in mind, like as he was saying, it's not that it's a totally bearish call. We're just maybe in a different kind of range at the end of the day. And I wonder if that's the case for the market overall in general.
Yeah, and I don't know how much of today's selling is also due to the fact that people are back at their desk. Remember, a lot of the price action we had in August was kind of distorted by the low volume. Maybe this is more of a reflection of how people feel.
Here's a question. How many research notes did you get about September being bad for equities?
I lost count.
Exactly.
So I think everyone has the same almanac, I think.
We do. They're all referencing the same thing, and we're all referencing each other at the end of the day. What is down, though, is the semis. They're getting hit quite hard. We're going to get some more insight on winners and losers from AI with Sam Palmisano, chairman of the Center for Global Enterprise and former CEO of IBM. If the semis are in a cyclical or structural industry, how do you invest within that? This is The Close on Bloomberg.
Just about 3:30 p.m. here in New York. This is the countdown to the close. I'm Romaine Bostick.
And I'm Alex Steele. Happy Tuesday on a sell-off on pretty high volume. It's not so great out there.
Yeah, not so great out there. I walked out the door this morning to go walk the dog, and it was like 50 degrees outside, Alex Steele.
I still have sandals on.
Okay.
I'm just saying.
I did see you come in this morning, and you were wearing open-toe shoes, and I had a scarf and and a hoodie on. Let's talk about this markets because things have been going crazy. We talk about an S&P and a Nasdaq right now around session lows. I was looking at the Philadelphia Semiconductor Index, down 7% on the day.
Yeah, it's pretty brutal out there. It's not just chips, it's also some of the AI plays. We were speaking earlier about some of those AI darlings getting hit with some short reports. So investors coming out and saying, I'm short the stock and this is why. And that has Lumen, for example, has gotten hit in part of that.
Yeah, absolutely. And it raises the question, Supermicro, Symbiotic, a lot of these other names here. I don't know, is this just a symptom of the fact that these were the high flyers? So, hey, if you made a lot of money off them and you're feeling skittish, why not just cash out? Or is this more symptomatic of people rethinking that whole AI trade?
Or the idea of, say, Supermicro is that now it's not in the small caps, it's in the S&P. So does that change who covers it and how they look at it? And that changes how you view the numbers. But either way, you're laughing at me.
I'm laughing because someday we have to talk about why Supermicro is even in the S&P 500. That's a whole other topic. I don't want to derail things right now.
But that's also why maybe analysts can now look at it in a different way, and then you have different analysts covering that stock, and that winds up hurting. But it does raise the question in terms of the AI trade. What is cyclical? What is structural? And then how do you invest in that? Sam Palmisano, chairman of the Center for Global Enterprise and former CEO over at IBM, joins us. Now, Sam, it's really good to get your perspective. We very much appreciate this. How does someone who's been in the technology industry for decades and understands innovation and understands a business cycle, what is AI right now?
Well, that's a great question, Alex, and Romaine, good being with you guys again. It's always a pleasure to be with you, especially on a beautiful afternoon. It's great to be in my office, not outside playing golf or something. But on a more serious note, no, I think that the best way to think about this, and I can draw parallels to the internet if you like, but we're still in the early stages of AI. And if you go back to the early days of the internet, what happens is phases. It begins with the enablers. And that would have been back then Netscape, Sun, Cisco, and AT&T. Today, you would put the enablers as the Microsoft, NVIDIA's, AMD, Anthropic's, the chip guys, et cetera, the foundational model guys. And then it moves to the adopters over time, but that's time. And that, if I go back to the internet, that would have been Meta, Amazon, DoorDash, Netflix. And then the next phase were the people that applied innovation to the technology, and that would be the Ubers, the Netflix, the Airbnbs, et cetera, and DoorDash, So that's the phases of this thing. And so far it's repeating itself. And we are in the early phase. There's no doubt about it. So the enablers are going to continue to, my opinion anyway, do well. Now, I mean, you guys know markets. I can't speak to valuations of what happens day to day. But long-term trends, I've seen this thing. I saw it in the early days of client server. I've been at this industry for like 50 years. So this isn't my first time to kind of view these transitions.
So, Sam, is the real boost in efficiency going to come from Romaine and I using it on our phones? Or is it going to come from like entirely new business lines and rethinking the way we fundamentally do things?
Alex, I tell you, that's a very interesting insight, because if you look at what's going to happen short term, if I quote McKinsey estimates of this sort of thing, they value the Gen AI that's got the adoption in the early stages of it in 4 key areas. That's customer operations, marketing and sales, software engineering, and R&D, i.e. productivity in a word. So they're saying the first phase will be productivity. That also could be productivity to the user on the phone, by the way, as far as their user experience, booking reservations or whatever it happens to be. It could be simplified by the application of AI. But in the enterprise itself, it's going to be more around productivity. Now, having said that, the real innovation comes, real value creation comes in the next phase. And I go back to my analogy of the internet. That's what I mentioned earlier: Uber, Airbnb, Spotify, Netflix. That is the next phase where this thing's going to take off. Go ahead. Yes.
So you're seeing a lot of parallels. I didn't mean to cut you off, but I want you to kind of expand on that because, I mean, your experience is relatively unique. I mean, you came of age, at least in your career, at IBM at a time when corporate computing was really taking off, then personal computing. You were still there when the sort of the internet age came about. And now you're not with IBM anymore, but you're still around here investing in what a lot of people think is going to be that next big new technology. I don't think anyone is doubting that this might be the next big thing. I think people are kind of doubting who the winners and losers are going to be. And right now, all the bets seem to be with such a small cohort of companies.
Well, that's exactly right. And that's how it was. Go back to the internet. It's a small core that benefited initially, and then it broadened out. And it broadened out when it got to the adoption phase, not the enabling. I mean, the infrastructure build out. That's why these guys are sold out, because everybody's chasing the infrastructure build out, i.e. the hyperscalers. And they're ordering GPUs and chips like crazy because they want to be ahead of the curve as this adoption phase or demand increases on the cloud providers, Amazon, Google, Microsoft, Azure, et cetera, et cetera. That's kind of where we are in the phase. I really do think that the hard thing to predict, I mean, go back in time, even in the early days of the internet when companies were digitizing, did people think it would be impacting how you take a ride in a car, i.e. Uber, or get a room someplace? Or get videos, media to place, and all that sort of stuff, or music? Nobody really conceived in the early days of the internet. It was more about digitizing things and putting your information up on the web and maybe doing a little bit of commerce.
Yeah.
Did anybody think that little bit of commerce would be Amazon? Yeah. So the point is now, to your point is predicting where it will go. I tell you, that's really hard. I mean, I'm an investor in this space. And, we're focused primarily in areas around healthcare and around cyber and those sorts of things.
And you're seeing the substantive use or potential use of this technology, because even when you go back to the internet age, and I know there was a lot of hype and a lot of folks who were predicting things that never panned out, but I think for a lot of us, at least the laymen out there, you could actually see the tangible qualities of what they at least were trying to build. AI just seems a lot more ephemeral.
Well, I mean, there's a couple of things. First of all, let's talk about the enterprise adoption rate, where great value can be created in these enterprise companies. And guys running these companies realize they've done the pilots, they've experimented, they've done these things, and they're going to chase productivity in the short term, but they're going to drive innovation in the long term. And that's the innovation in the enterprise. There are still limitations in the technology. I mean, for example, accuracy and transparency and validity. If you're doing financial services, or you're doing national security, or you're doing healthcare, and you're worrying about people that are going to live or die, you need those issues to be addressed. And they will be addressed. And there are a lot of startups trying to address a lot of those and those areas of inadequacy that exist today. So therefore, you see things being applied to what I call a simpler use case, like marketing, like customer service, et cetera, et cetera. I do believe it. Now, these cycles, as I go back to the internet, they're like 10 to 15 year cycles, right? So, I mean, we're in the year, 3, maybe, depending upon how you count this stuff. So, I mean, we have a long way to go. And from an investor, I mean, I'm basically a VC today. I'm not involved in large companies. I'm an advisor, but I'm not really involved day to day. Fundamentally, from a VC perspective, we're making bets in those industries where the technology could have a massive impact. For example, the delivery of healthcare or therapeutics and those sorts of things. Massive impact to improve the system, to drive productivity, to improve outcomes. That could be significant. Financial services, there's a lot of things that can be done in financial services, again, to improve value to society and value to the companies themselves.
All right, Sam, I have to leave it there. Great insights, as always. Have a wonderful day. Sam Palmisano, he's the chairman of the Center for Global Enterprise, as he said, a VC funder in the AI space, and of course, a longtime IBM employee who rose to the top of the mountain there. Coming up here, Alex, we're going to talk about some of the big stocks moving on the day, and that includes Boeing having its worst day going back to January. It's our stock of the hour. We're going to talk about it when we come back after the break. This is Bloomberg. Boeing. It's hard to see the upside in the shares. That's what analyst Matt Akers over at Wells Fargo said this morning. His latest recommendation note pushing the stock down about 8% here on the day. Boeing's market cap now sitting below $100 billion, and it is our stock of the hour. Abigail Doolittle joining us now to talk a little bit more about what's going on. And I assume what's going on is the same old, but there's no turnaround here. This is the same old story, yet analysts continue to turn bearish on this stock.
Well, it's interesting. So this analyst over at Wells Fargo is really the first big bank analyst to just throw in the towel, like, the kitchen sink, basically say everybody's worst case scenario. And you have to imagine that they probably don't have banking relationships. The other big analysts who I have been told are not.
Well, you're not supposed to talk about the conflicts of interest out loud.
Yeah, well, sometimes we have to, because it's interesting. There's 36 analysts covering this. There's only 3 cells on it, and yet they do have a world of hurt. So basically what he's saying is, the bottom line of what he's saying, their worst problem is they need a new plane. I would say they need a whole new plane, messaging, communication strategy, but at the end of the day, it's going to be that plane, and then these other planes that they've had issues with can be the old Boeing, but they've improved it. But they need a new plane. Those production costs are going to, or development costs are going to outrank production growth. So he's saying free cash flow will peak in 2027. Now, what's interesting to me about this is most stocks, they're trading 6 months to 12 months out. So the fact that folks are going along with him so far out into the future really speaks to this idea of, again, throwing in the towel. He's also saying that there's a possibility of a strike next week. Yeah. Is that what you were?
That's what I was going to add to it. Is that it seems like the unions want like a 40% pay increase.
Yes.
It wouldn't necessarily be all at once, but if they don't get something along the lines and other stuff that they want, they could go on strike. In which case, then Boeing can't deliver planes. In which case, there is no free cash flow.
Well, you make a great point, and the automakers really set the stage for that 40% to start at that point, and they have a number of other demands. If Boeing doesn't give in to all of them, they will go on strike most likely. It seems as though the analyst has inside intelligence on that is very, very likely. Then they're dangerously low in cash for both production and dividends. So he's saying that they are going to have to raise equity because of that, and then dilution. And then on top of all of those micro concerns, he is saying that demand for air travel is weakening and therefore demand for Boeing planes. So this is why he's really just throwing in the towel, the worst case scenario that anybody could see.
I thought it was kind of interesting that this note would come out after Boeing named the new CEO. I mean, he took over, I think, officially, right, last month. But the idea here that the overhang was kind of the previous CEO and the idea that they still hadn't filled that role. You got a new guy in there. He's been there, I don't know how many weeks or days at this point. Why not give him a little bit more of a chance?
Romaine, that's a really great point.
Thank you.
To give him a little bit more of a chance. It seems as though this analyst is really taking a harsher stance, thinking that the problems that Boeing has are so insurmountable at this point that no CEO, no matter how great they are, will, even if he turns out to be a Larry Culp, is going to be able to turn this thing around anytime soon.
Well, I think it's also because he's not Larry Culp.
Larry Culp.
I think if Larry Culp was, if they drew him away from GE, that would be something.
Yeah.
What's Brian Nichol doing? Can he?
Isn't he the
that
pay package?
CEO?
How big would that pay package? Maybe he could do both jobs from his desk at home, making
food and planes. I feel like they're different. Anyway, all right, Abigail, thanks a lot. Really appreciate it. Abigail Doolittle joining us there. But it is hard to see sort of where the stability is going to be in Boeing. But if you look at a chart, I mean, we're still not back to 2020 pandemic levels or anything either. So there could be some more room on the downside for that.
Yeah, and we should point out, despite Boeing down more than 8%, it is not the biggest decliner of the day. Stock still at session lows. We're down 3.5% right now, Alex, on the NASDAQ.
You know what's down?
No.
The power companies that support data centers. They're getting hit
over.
hard in the S&P. It's all over. We'll break it down into the close. This is Bloomberg.
There's a orderly unwind and a disorderly unwind. The Fed cut is expected. If they were to be much greater or something like that, it's probably going to be a very orderly process as we move back to lower risk-free rates of return, or think about the cost of capital holding oil in the financial as well as the physical, where that's going to begin to unwind.
All right, order and disorder, call it what you will. Still a sell-off here on the day. Jeff Currie speaking with us a little bit earlier to kick off the show, Alex. We are just about 10 minutes into those closing bells, and barring a miraculous Hail Mary, this thing is going to end as one of the worst days that we've seen, actually since the start of August, but still.
But to be fair, August was really bad. So if we do that, the superlatives get a lot worse. You're looking there at what's leading the decline, and it's really going to be tech. Look at the semi-index, the SOX index down a full whopping 8%. NASDAQ 100, biggest loser, tech and consumer services. services are the worst performing sectors in the S&P. And no surprise, the Russell's getting hit harder, but relatively in line to what we're seeing for the rest of the market.
Yeah, and it's interesting we kind of allude to that beginning of August, because remember, we had that big sell-off in August, but August actually ended up, at least for the S&P, and I think the Dow, I think the NASDAQ had a little bit of struggle. So there were a lot of people that looked at that, was that the first 3 or 4 days that we had that sell-off in August, and then came in and bought that dip. Whether that happens again remains to be seen. Let's pose that question to our next guest as we continue to count you down to the closing bells. Emily Leveille, portfolio manager with Thornburg Investment Management, joining us out there from beautiful Santa Fe. Things are bright over there, not necessarily bright on Wall Street. Emily, I guess the question is, as fundamental investors, as bottom-up investors, when you look at a sell-off like we have today, is this being driven by fundamentals? Is this being by macro or technical?
Hi, nice to see you guys. Thanks for having me again. I think it's a bit of both. I think you're starting to see the growth scare narrative re-enter the picture today. You saw sell-off not only in tech, but also in the energy space and commodities, that coming from some weak data points out of China as well. I think that selectively you could absolutely buy the dip. We're still big fans of the AI investment theme in the long run. But what you buy probably changes a little bit. I think, what we saw from NVIDIA after earnings is an indication that, maybe a lot of the good news is in the price. Maybe investors should look somewhere else. I would be thinking about broadening that AI exposure. Names like AMD, TSMC, ASML. These companies still haven't recovered from as much from the August sell-off as well.
What gives you the confidence? Let's just take one of those names, AMD, for example. Largely considered to be a laggard in the AI space, trying to play catch up with NVIDIA. What gives you the confidence that they will catch up, or at least catch up enough to make that a worthwhile investment?
I think it really has to do with expectations and the expectation setup. So, we have seen AMD be a share gainer in data center GPUs over the last 3 or 4 quarters. That gives us confidence that, they are making progress. People want to see them as a secondary supplier for data center GPUs. The recent acquisition that they've made of ZTS really starts to give them a more complete suite in the AI space. So now, they can offer a more complete service that rivals NVIDIA's in data center design, in networking, and software. So, really moving into some of the more high value added parts of the AI solution space. And we just think that expectations are also a lot lower for AMD than they are for NVIDIA, where it feels like even if everything's going right, the stock isn't necessarily responding positively anymore. It gets harder to get those beats and raises from here. So that's why we really like the setup at AMD better. Plus, we think the fundamentals are moving in the right direction.
What semis would you be selling right now, Emily?
We definitely see that the NVIDIA trade is, probably a good source of funding. I think that in general, what's interesting about the semi space right now is that you're seeing a broadening out. So if we take AI out of the picture, if we look at names like TSMC and ASML, the thing that's going to drive TSMC's earnings in the next few quarters isn't necessarily going to be AI. It's actually going to be the recovery of some other parts of the semi space. So, if we look at CPUs, for example, if we look at PC recovery, in the industrial space as well, we're starting to see bottoming out. So I actually would think about looking at a slightly broader exposure in the semi space than focusing just on NVIDIA.
All right, talk to me about the safety trade, because we're definitely seeing it today. Consumer staples, the only stock within a sector within the S&P that's up. Real estate utilities, though, pretty much flat. Where in the safety trade would you like right now?
I like staples. I also like healthcare, really like healthcare still. We talked a little bit the last time about GLP-1s. We've got some really, really interesting new areas where we've seen therapeutic transformations. Alzheimer's is another area. We have 2 approved drugs in the market in the U.S. now to treat Alzheimer's. This is a huge market. It's at very nascent stages. The fact that these drugs are approved, means that that these drugs have already been de-risked, and we think that expectations are very reasonable. GLP-1s, we continue to really like. We think this is a very broad market with a long run rate for growth, and we think Lilly and Novo are probably still your long-term winners.
But based on that, yeah. What about in the consumer staple space?
consumer staples is still really tricky. I think what we're seeing and what we saw in the U.S. in the consumer space in general is really a mixed picture. So yes, some staples are maybe safe havens, but consumer staples really took a lot of price during COVID. And I think you're seeing in the consumer and commentary from companies that, the consumer is really value seeking right now. And that's not necessarily making it easy to pick the winners and losers. So, in staples, I would be focusing on companies like Walmart that have shown resilience in both the consumer trading down from sort of a higher level of income to a lower level of income. But, if you look in that space, we saw last week, for example, Dollar General, very weak numbers. We saw Burlington Coat Factory as well. So the consumer space is actually really mixed. And I would still focus on, as a fundamental growth investor, would be focusing on businesses where I can see a path for growth that is really irrespective of what the consumer and what GDP is doing. Companies like Alcon, for example, cataract surgery, the number of people that need cataract surgery is going to grow in the mid-single digits in the U.S. and globally every year, regardless of what GDP is doing.
All right, Emily, always a great conversation. Great to have you here on the program. Emily Leveille providing some tinge of optimism on a really down day. Portfolio manager over at Thornburg Investment Management. Stocks, at least in aggregate, still not far off session lows. 2% on the S&P, 3% on the NASDAQ. And, of course, a lot of this being led by that big downdraft in tech stocks.
But to your point, and also to Emily's point, buy the dip. Maybe where you're buying it is different, but definitely sort of in the market to buy the dip. Also, hedge funds were sellers of tech at the end of August, so you also wonder if they have some liquidity and some dry powder now. I'm glad you brought that up because it's obviously going to take a few days before we see the data, but it'll be interesting to see the complexion of this sell-off. Is it coming from the hedge funds and institutions? Is it the algorithmic traders, the CTAs, or is it retail? Because that's going to determine whether the sell-off really continues or whether it is just kind of a blip. Which just really leads to the VIX and just how powerful that move upward in the VIX is. We get over 20, do we kind of stay there? And that, to your point, will lead to that as well. Also, dollar yen, got to see. Carry unwind, is it happening? The VIX up about 5 points now, right around that 21 level. Stocks near session lows. Stick with us. A full breakdown of all your market action coming up now on Bloomberg.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick alongside Alex Steele taking you to the Closing Bell. A global simulcast starts right now. Scarlet Fu joining us in the television studio. Tim Stenovic in the radio booth. Katie Greifeld filling in today for Carol Master, who I guess got a little shook here when she took a look at the red across the screen. Tim Stenovic here as we welcome our audiences across all of our Bloomberg platforms, including our partnership with YouTube.
Just red across the screen. Not really anywhere to hide. There were a few gainers that I could find, but the NASDAQ 100 down more than 3% right now. I'm looking at NVIDIA, which has shed more than $270 billion in market cap in a single day, Katie. If this holds, that'll be the record for the most, beating Meta.
Yeah, it's pretty ugly. At least you have the bond market at your back right now. I mean, you do have a hedge that's out there, and it's good news because you take a look across the stock market right now, from big to small, pretty much every sector in the red right now.
Pretty much every sector. There are a couple of sectors like utilities or staples that are holding up a little bit better. I look at volume, and it is zooming up 18% on the 20-day average after an entire month in which we saw it below the 20-day average. It's refreshing to see all this movement back into equities, even if it is on the downside.
Where's the money going, guys? Bond market, and it's going to the yen at the end of the day. That's where you're seeing the safety trades, particularly in the long end of the 10-year. I'm glad you brought that up because we kind of forget that a lot of times this is all relative, right? It's the money comes out, but it actually has to find a home somewhere. And we were talking earlier, Alex, with Jeff Currie, who's now over at Carlyle at Energy Pathways, and he was kind of making that point, particularly when it comes to the commodity trade. Yeah, he was saying the carry unwind is also in the oil trade, and you could see a snap up if the unwind happens. All right, of course, we did have crude settle lower, back down around that 70 level in New York and down below that 75 level in London. As for equities here in the U.S., red across the board. A Dow Jones Industrial Average down more than 600 points, or about 1.5%. An S&P 500 down more than 100 points, or 2.1%. Your NASDAQ composite is going to close out the day lower by about 577 points, or 3.2%.
And take a look at the Russell 2000 here. Not your laggard, believe it or not. That actually belongs to the NASDAQ, but the Russell's still down 68 points or 3.1%.
There were, believe it or not, about 150 stocks, 149 to be exact in the S&P 500, 147, still getting settled. That did move higher today, that were in the green. 354 stocks, Scarlett, did move lower.
All right, so let's take a look at the IBAT, because as the three major indexes, the four, if you include the Russell 2000, show a lot of red, there are some green slices there. Consumer staples up by 0.8%. You have names like Molson Coors gaining. Also, real estate investment trusts, REITs, up by 0.3%. And then you've got the flip side, the decliners. Tech really getting hit hard, especially those semiconductor names like NVIDIA. Energy stocks losing 2.4% as oil prices unwind, and communication services losing 2.3%.
All right. Well, you mentioned a couple of these sectors that are actually in the green, and a couple of the names as well. Defensive names higher today. One of those being AT&T, up by 2.8%. It's actually in the day reached its highest going all the way back to February of 2023. Another stock higher, and this one is kind of a sort of an outlier because it's not necessarily a defensive play, but there was some news around an upgrade. Unity Software shares, they gained as much as 11% earlier in the session. The company was upgraded to overweight from equal weight at Morgan Stanley. The bank sees clear potential for upward revisions in the toolmakers create business and greater stability in the grow segment. Unity up by 2% today. And then, Scarlett, you mentioned Molson Coors, ticker TAP, another defensive name that's higher today. No fundamental reason why, just the fact that it is defensive, but there was some news around the company, not why it's higher. The company did come out and say, like a lot of other companies in recent months, it's cutting back some of its corporate diversity efforts, joining a corporate retreat hastened by an anti-DEI social media campaign, Katie.
All right, an embarrassment of riches when it comes to decliners today. I have to start with the big one. I have to start with NVIDIA, closing down 9.5%. That, of course, is its worst day in about a month or so, August 5th, and not really on any news, as we know, just that maybe the calendar flipped and it dragged down all the semi-names with it. So NVIDIA,
can I correct you, Katie? This is the part I love doing with Carol when I get to correct her. It's actually down the most since April, but...
Well,
nobody's counting.
Well, compare if you look intraday, it's down by the most since August 5th. You have to check the box on since.
Okay, keep going. Romaine, what do you have?
On a closing basis. Come on. There you go. Down. But at least when it comes to intraday, worst day since August 5th. Let's move on. Let's talk about U.S. Steel, of course.
Wait, did you just correct me?
I did.
That's
I don't like, Katie, I don't like when the tables are turned on me, Katie. You know that.
Well, before I get kicked out of this simulcast.
She's not coming back tomorrow at this rate.
Let me go through the other decliners on the day. U.S. Steel. This was an interesting political story. Of course, Kamala Harris saying that U.S. Steel should remain American-owned and run. This is Joe Biden's position as well. It's also Donald Trump's position, but there had been some optimism that maybe she'd break ranks here. She did not, and of course, that added up to a pretty big loss for U.S. Steel. And then we got to talk about Boeing, of course, the story that gives on giving here. This coming from a Wells Fargo downgrade, the downdraft that we saw today. Wells Fargo coming out, downgrading the stock and also setting a street low price target. Basically, the rationale there is that it's hard to see upside in the shares from this point. That was good for another 7.3% decline for what's already been a very, very ugly stretch for Boeing.
Yeah, so where did the money go, guys? I mentioned it earlier, and it went into the bond market. It also went into the yen. But you did see buying across the curve. You saw the 10-year yield down by about 6 basis points, the 2-year down by about 4. We did see more of a robust rally in the back end earlier, but as the day went on, we kind of lost a little bit of that. The question now becomes, can you, at this point, chase the bond rally, particularly when the 2-10 spread is again sort of nearing that parity level by about 3 basis points?
I am also curious here about kind of the positioning heading into, obviously, a big week for data with the jobs report on Friday, and then in about 2 weeks' time, of course, we get the actual Fed meeting itself here, and how much of this is related to that as well.
Yeah, one question that Katie and I have been asking throughout our program is, okay, what changed in the 3 days between Friday and today, apart from a 3-day weekend and people coming back from vacation? What was the fundamental data that we got today, or what's the news that the market's reacting to? I can think of ISM, but other than that, what else is out there that could spur something like this?
I was curious too, because I looked at that too, but the stocks were already kind of weak before that data came out. So I don't know. I mean, the answer, Tim, is I think a lot of people, maybe all the bears were gone in August because they were all on vacation up there and, wherever they go, and maybe they came back today.
All right, we have some earnings, believe it or not. I know that we keep talking about how earnings have ended, but Zscaler has just come out with numbers. And for the quarter that ended, fourth quarter revenue was $592.9 million. That does beat the average analyst estimate, and adjusted EPS was 18 cents better than what analysts were looking for. In terms of revenue for the current quarter, it sees first quarter revenue of up to $606 million from 604 to 606. Analysts were looking for somewhere in the neighborhood of 604.8 million, and full year revenue will be 2.6 billion to 2.62 billion, very narrow range, while analysts are looking for 2.63 billion. So that outlook being a little bit lighter than anticipated is pushing that stock lower, and you can see the losses deepening here, more than 5% down in after hours trade.
Meanwhile, you have GitLab, of course, the coding and software platform, coming out with their fiscal second quarter results, $182 million in revenue in the most recent quarter. That was a beat. EPS coming in at 15 cents a share. That was also a beat. Its guidance for the full year, revenue in the range of 742 to 744 million, also a beat there. And their guidance on adjusted EPS for the full year, guys, 45 cents to 47 cents. That's about 10 cents higher on the high end of what the street was looking for.
I'm digging into the GitLab press release, and the company's CEO coming out and saying that the results show the combination of end-to-end platform and AI solutions are driving results for our customers by aligning to business goals, providing measurable benefits, Katie, and improving security.
And it's a good reminder that earnings season is not over. It never ends, as I like to say. You think about sort of the complexion of this week. Yes, we have a lot of economic data to look forward to, but we also have Dollar Tree earnings. We have Hormel Foods. We have Hewlett Packard Enterprises. We also have Broadcom, which of course was caught up in today's sell-off with NVIDIA dragging down the whole sector. So a lot to parse into when it comes to the individual micro names as well.
Well, not only that, but you take a look at the semis in general, right? And there was a report out that showed that semi sales were off by about, 11% in July on a month-on-month basis. That comes from UBS. So as a whole, sort of dealing with that cyclicality in the chip market, despite that structural shift when it comes to AI.
Yeah, I'm looking at the declines. Just as a final number here, the biggest drop for the Philadelphia Semiconductor Index since March of 2020, since the pandemic, losing 9.8% on the day. All 30 members lower.
Yeah, and this gets to the thing, though. What was sold today, right? Was it just kind of those high flyers and people either taking some of those profits or protecting against further losses, or was it something? Was it something broader?
Well, what would you consider Apple? Would that be a high flyer, or would that be a sort of a something broader?
Because like a steady Eddie almost.
It's a steady Eddie, 2.72% to the downside today. Microsoft down 1.8%.
Compared to its peers, that's not bad, right?
Yeah.
Are you going to get one of those new AI-powered iPhones that is supposed to come out?
It's supposed to be unveiled, next week?
Unveiled? I heard there's not going to be any AI in it, though.
Remains to be seen.
Right?
I don't really need a new phone yet.
Do you guys remember the Best Buy earnings from last week? Was it Best Buy?
That was a long time ago.
Well, it was last week.
Oh, I have a Best Buy story. We don't have time for it, though.
That was a long time ago.
Yeah, we actually went into Best Buy this weekend.
Oh.
Yeah.
Did you buy stuff?
Yeah, we did. We bought a school computer, and it was an experience, let's just say.
Were the store shelves bare, or were they full?
Let's just say they need to work on customers.
Did you walk out with a computer?
Yeah.
You did walk out with a computer. You were able
we
to
did,
successfully.
yeah.
Okay. All right. Mission accomplished then. That is going to do it for our cross-platform coverage of the market close on Bloomberg TV, radio, YouTube, and Bloomberg Originals. We are all going to be back here tomorrow, same time, same place. We'll see you later.
And of course, the health of the consumer is front and center for a lot of investors, not just with the earnings, but also the economic data. A conversation up ahead with the Director of Consumer Research over at LSEG. That's coming up here on The Close on Bloomberg.
Welcome back to The Close. I'm Scarlett Fu.
And I'm Romaine Bostic. A down day to start the month of September, just as the stock market almanac said that it would. Down 2% here on the day on the S&P 500, 3% declines for the NASDAQ composite. But this was kind of an everything sell-off here on the day. You saw that reflected in a lot of other asset classes, including Bitcoin and in NYMEX crude. NYMEX crude down around $70 a barrel. Brent crude closing below $75 for the first time all year long. There's your 10-year yield, Scarlett, drifting a little bit lower here as a lot of people did take some of that money out of stocks and put it into the safety of bonds.
Yeah, you mentioned everything sell-off, but it was definitely focused on one corner of the market, and that is technology, and more specifically, chip companies. NVIDIA losing as much as 10%. It's down around 13-14% since its second quarter earnings last week, failed to live up to those very lofty expectations. And you could see how it dragged the Philadelphia Semiconductor Index to the biggest decline since March of 2020. All 30 members lower by at least 4% today. Now, the chip makers, of course, have been clear beneficiaries of all that spending from Microsoft and Alphabet, but those companies have had little ROI to show for it. So the question is whether this spending can continue. And I wanted to point out a gainer here. Philip Morris closing at a record high.
Cigarettes.
Record high. Oh, well, here's the thing. The CEO participated in a Barclays Global Consumer Staples Conference, and he reaffirmed the company's full-year EPS forecast.
All right.
So that's taken as good news in a market like today.
All right, chips down, nicotine up. That is our top story of the day. Today's market meltdown, led by some of those big tech names. Bloomberg Opinion columnist Jonathan Levin joining us right now. He says that it's that time of year when Wall Street strategists rush to boost their S&P 500 targets, and the flurry of upward revisions can look something like a short squeeze, he says. This year has already been the biggest short squeeze among strategists in a decade, and seasonal trends suggest it's poised to continue in the coming months. Jonathan joins us right now to talk a little bit more about this. And we were making hay a little bit earlier in the program, Jonathan, about how just, August 30th, just a few days ago, we were like 20 points away from the S&P reclaiming a record high. We've already seen those price targets elevated, as a lot of people thought they had missed out on the rally. You're saying we're not going to see those year-end price targets, those 12-month price targets come down?
Well, I think on the contrary. I mean, look, the average Wall Street strategist is still well below where we're trading today, I believe. The fact of the matter is we still have 4 months to go. The fundamental story has not changed that much, as I heard you and your colleagues commenting on the program just a few minutes ago. We're still looking at a market where there's still a compelling AI story. NVIDIA, of course, is getting killed out there today, but NVIDIA's earnings were not actually that bad. All that we saw recently was a step down from really, really extraordinary to pretty darn good earnings. And then fundamentally on the economy side, we're still looking at an Atlanta Fed GDP now that's expanding at around a 2.5% annualized pace. And so, I struggle to see where a lot of the real bearishness comes from over the medium haul.
Well, that being the case, what do you think it is about economists and strategists that has them underestimating consistently the strength of the economy and the strength of earnings? Are they following a playbook that just doesn't apply anymore?
Yeah, I think it's tricky. I mean, I think obviously part of it has been the top-heavy nature of this market, and that obviously brings with it risks of its very own. But you might say that this has been more of a market for the bottom-up strategists as opposed to the top-down. And then fundamentally also, let's not forget that strategist colleagues over in the economics departments have also just had a really, really hard time understanding what's going on in this very, very bizarre post-pandemic economy.
I'm glad you brought that up, too, because there are so many distortions in the price action that we've seen really all year long and going all the way back, of course, to the pandemic here. And it sort of raises the question as to what actually gives people the confidence to stand by any of these targets. If it's not just corporate fundamentals, if it's not just economic fundamentals, then what else?
Yeah, I mean, look, let's take a step back here. Price targets have been sort of a favorite whipping boy of mine for a while, in the sense that there is a false precision in these things. I would be more of an advocate of sort of a scenario analysis sort of thing. There are so many bright people working in these strategy jobs on Wall Street, and I think that, frankly, they are smart enough to know that trying to pinpoint where the index is going to the point level is just a hopeless pursuit.
All right, Jonathan Levin, really appreciate your joining us. Jonathan Levin of Bloomberg Opinion, really interesting read here. Wall Street strategists face their own short squeeze in his column today. Well, of course, investors are bracing for a further glimpse into the health of the consumer. You do have a number of earnings reports from retailers coming out tomorrow. Dollar Tree, Dick's Sporting Goods, and Casey's General Stores, all due to report. Joining us now to discuss the consumer is Jharonne Martis. She is Director of Consumer Research at LSEG. So, Jharonne, we have had enough earnings reports out of retailers to know that there's definitely some winners and some losers. There's a pretty clear divide. You have companies like Best Buy that surprised to the upside, Walmart, which is winning on all accounts, and then others like Dollar General that just can't seem to get it together. What are the common threads that unite the winners and also are pulling down the losers?
Well, in general, there's been two main themes that have come up this earnings season. The first one being that the consumer is extremely value-oriented. We're seeing that they're waiting until there's like discounts and promotional events to open up their wallets. We're seeing that the middle-class consumer is thinking twice about spending anything above $1,000. And then any retailer that has like a strong omni-channel strategy is winning, meaning that the consumer is all about instant gratification. They want to be able to order it on their phone, pick it up on their way home, and those are the retailers that are seeing the very strong numbers.
So can retailers become winners just by discounting their way to sales?
No, they have to offer that value and that convenience. So if, for example, take into consideration Dollar Tree that is expected to report tomorrow, they are slacking in the sense of like offering that consumer the effectiveness, the omni-channel experience, but they are very good about value with their prices. So a company like Dollar Tree, they would actually benefit from the fact if consumers were be able to order something online and have it delivered either through DoorDash or Instacart or something like that.
But that's not really their business model. And,
no.
And I'm curious about the parallels with Dollar General, because that rattled a lot of people last week, particularly the CEO's comments about the health of the consumer. And I wonder, was that kind of a little bit of him just kind of trying to pass the buck? Was what ailed Dollar General more their own internal issues rather than a broader decline? Because Walmart seemed to do fine. Costco seemed to do fine. I mean, there are a lot of sort of places that cater to low-income consumers that seem to be doing fine.
Absolutely, but there's a lot of different factors here at play. First one being that in the past, that consumer that used to go into Walmart used to go in only for groceries and then go for Halloween gadgets and Christmas gadgets at the dollar stores. But now, while they're shopping for groceries at Walmart, Walmart has improved their selection and it's able to do that offering value prices. So as a result, the dollar stores have lost a lot of that market share to the big box retailers like Walmart.
So when we hear from Dollar Tree, you think we're going to hear more of the same of what we heard out of Dollar General to a certain extent?
When we look at our StarMine data, we're seeing that the buy side is growing more pessimism around this company. Also has negative price stock momentum. So there's a likelihood that we're going to see them also lower their full year guidance.
What about specialty retailers? And I'm talking about companies that really have to sell goods tied to the housing market, Restoration Hardware, for instance, or Wayfair. I mean, the housing market is still doing very well. It's holding up. There's not as many transactions because people are waiting for interest rates to fall, and the affordability issue still continues to be a problem. But Home Depot, Lowe's are talking about this deferral mindset. How do they wait this period out?
Well, they're in the period of post-pandemic normalization. So, for example, for a company like Restoration Hardware, we're projecting to see, yes, a slowdown of 1.8% comp. That's expected to slow down even further into the third quarter. That's a trend we're seeing overall in the retail space. But then there's another factor here at play, which is that, traveling has slowed down into the second half of the year. So that means that consumers are more keen to be at home this holiday season and entertain as opposed to traveling. So that actually could help boost the housing retail group again into the fourth quarter. So
let's look ahead, because when we talk about the discounting that we traditionally get around the Black Friday, the Thanksgiving and Christmas holidays, obviously the Christmas season, you mentioned Halloween, which I should point out is our favorite holiday in our household because, one special person, her birthday's on Halloween. But
yours?
The question, not mine, not mine, no, I'm a Cancer. You can't tell? Yeah, I'm sensitive.
Water sign.
But in all seriousness, when we talk about whether people will spend in the traditional way that we expect them to spend, should we lower our expectations now, or do you think people will still be in the spirit to kind of, put stuff in their credit cards and max things out for the sake of?
So this is an interesting year because it's also an election year. We still have elevated prices. There's a lot of going on. The unemployment is flashing red. So there's a lot of volatility in consumer sentiment. But having said that, our projections at LSEG are telling us first quarter was strong, 30% growth rate for earnings, slashed in half second half. So for this earnings season, we're expecting about 15% growth. Going into the third quarter, that number is expected to decrease to 1%.
Dramatic slowdown.
Yes. And then it doesn't improve until we go into the holiday season around 9%.
All right, so it looks like
By the way, July 20th, put that on their calendar so you can get me something
everyone
nice.
put it down on the calendar. Jharonne Martis, thank you so much, Director of Consumer Research over at LSEG. Coming up, we've got the top three, where we focus in on some top three movers and shakers at the center of the day's big stories, and some of them take place at the U.S. Open. This is The Close on Bloomberg.
The U.S. Justice Department has sent subpoenas to NVIDIA Corp and other companies seeking evidence that the chip maker violated antitrust laws. That headline crossing the Bloomberg terminal right now. We are learning that the Department of Justice here in the United States, which had previously delivered questionnaires to companies, is now sending legally binding requests that oblige these companies to provide it with information as part of an investigation into antitrust issues. NVIDIA Corp, the biggest company in that list of names right now. You see the effect on the stock, only down about 1%. We should point out that this is according to people familiar with the situation, people familiar with that investigation that our Bloomberg reporters have spoken to. Scarlett, we do know that this probe had started at least back in June. We had reported that back then, but this does appear to be an escalation and an expansion of that probe.
Yeah, previously it was delivering questionnaires to companies, having them answer and kind of taking stock of everything. But now this seems to have taken another step that moves it closer to perhaps launching a formal complaint. You mentioned the stock is down in after hours trading by about 1.5%. It doesn't seem dramatic, but this is after a day in which the stock tumbled 9.5% on the day, and in general lost as much market cap as all of Chevron, just to give you a sense of the scope of the decline that we've seen in NVIDIA and in chip companies overall. Yeah, and this was getting to the idea, and we should point out, too, based on Bloomberg reporting, we have not gotten a response yet from the Department of Justice or NVIDIA, but of course, we are reaching out to them for comment. But this gets to the broader issue here, too, is everyone's been looking for that crack in this AI story, whether it was fundamentals, whether it was corporate spending, blah, blah, blah. This is just one more thing in the pile. So whether this actually sinks it or not, it's more, I think, the cumulative effect that people have to be on guard for. Right, and this one's completely out of its control as well, with antitrust officials concerned that NVIDIA is making it harder to switch to other suppliers and penalizes buyers that don't exclusively use its AI chips. The problem is there aren't many other options right now. Yeah, that's the thing. I mean, we have no idea what NVIDIA is actually doing, but the question is, if you want to go somewhere other than NVIDIA, is the fact that you don't have anywhere else to go because of NVIDIA or just because of no one else has come up with a really viable competitive chip in mass? Right. We know that AMD is trying its best, but it's not anywhere close to being the kind of supplier that NVIDIA is, and all these other hyperscalers are busy working on their own chip, but that's not going to happen in the next 6 months or even a year. That's going to be a longer term story. So in the meantime, they're all piling in and trying to buy NVIDIA chips. Yeah, we're going to try to get us a lot more details on this, and we are going to stick with this story here. Once again, the headline, the U.S. Justice Department sending subpoenas to NVIDIA Corp and other companies seeking evidence that the chip maker violated antitrust laws. No response yet from NVIDIA or DOJ. All right, we've got much more to cover on this. We'll continue to talk to our reporters to get more insight on this. This is Bloomberg. All right, let's get back to that breaking news on NVIDIA, learning that the U.S. Justice Department has sent subpoenas to NVIDIA and other companies seeking evidence that the chip maker violated antitrust laws. This is according to people familiar with the investigation that our Bloomberg reporters have spoken to. We should point out we are still awaiting comment from NVIDIA and the DOJ itself. Joining us right now is Ian King, Bloomberg News reporter covering the semiconductor space for us. Ian, talk to us a little bit about what it means when they say they're seeking evidence of antitrust violations. What exactly are they sort of hinting at?
Right. In this particular case, we've reported a while ago that there was questionnaires going out, that they were just sort of asking customers, asking competitors, what was going on in the market. The fact that this has gone to the subpoena stage, the legally enforceable request for information, is usually a sign of an escalation. In terms of what they might be looking for, things like bundling, things like taking action, perhaps punitive action against companies that don't use it exclusively, that perhaps look at other alternative suppliers, because as we know, NVIDIA has a very, very tight control over the supply chain for a particularly important product at this point.
And when we talk about the DOJ making inquiries into these kinds of issues in the past, you and Leah Nyland reported that the U.S. opened antitrust investigations into both Microsoft and NVIDIA. At the time, did we have a good sense of what it was specifically that they were looking into?
Yeah, I mean, in general, every government, every regulator around the world is looking at AI as being not only extremely fast growing, but also extremely important with all kinds of economic and indeed security implications. So our understanding at the time was, there were things like NVIDIA's purchase of a small AI startup. There was obviously Microsoft's relationship with OpenAI, that all of these things that, the sense was that regulators wanted to get ahead of this, didn't want anything to become too entrenched before they had a close look.
Let me ask you a kind of a dumb question, Ian. But when you say this idea that there's concern here that NVIDIA is making it hard to switch to other suppliers or penalizing buyers that don't sort of use exclusively NVIDIA's products, are there competing products out there? I mean, at least in mass, that these companies would even be able to go to?
Yeah, no, that's a very good question, Romain. I mean, clearly NVIDIA is way ahead. But you've got to bear in mind, company like Amazon AWS, for example, and this is just an example, this doesn't have any relevance to our reporting, they do their own networking, they do their own servers. So NVIDIA, as we know, supplies all of those things, networking, servers, and the chips itself. So what could be under investigation, and what we believe is under investigation, is the relationship, between the supply given to those that aren't exclusive users of its stuff. And of course, AMD is in the market as well with accelerators.
Ian, with your decades of experience covering semiconductors both in Asia and in the U.S., you've seen this happen before, where the government takes a closer look and starts sending subpoenas. How do you expect this? What do you expect is the next step? What will you be looking for in terms of how quickly this might move?
That is something that's, difficult to say. What we can say is that clearly regulators are very keen to have a look at this particular area and to act quickly before it becomes entrenched, like we saw in the past with certain Microsoft products, like with Google Search. Years down the line, they start to take a look at it. This one feels much more on point and abrupt, and an effort to sort of get involved right at the beginnings almost of an industry.
Yeah, it makes a lot of sense. Ian King, thank you for staying on top of this. Ian King, with the scoop that NVIDIA has gotten a DOJ subpoena in an escalating antitrust investigation. We'll, of course, bring you more details as we get them. Meantime, you look at the broader economy. There's a slew of data this week, including JOLTS out tomorrow, followed by ISM services. And then you've got ADP data and jobless claims on Thursday. And all of it is a part of the drum roll leading up to the main event, which is the August non-farm payroll on Friday. Elise Gould of the Economic Policy Institute says this is a key week for the Fed. They're a bit behind the curve and need to get rates back to neutral. Elise joins us now. Elise, we talk about the jobs numbers that everyone's anticipating at the end of the week, but it feels like people are already reacting to the data that we got today, given how much equities declined and how much treasuries rose. I look at, for instance, the price action in equities today, and indexes took a big leg lower after the ISM manufacturing numbers. Did that report start to really revive the growth scare concerns?
I've been really paying attention to what's happening with the other data releases that are coming out this week. So looking forward to JOLTS and Jobs Day, as you said, the ADP report. And I'm looking forward to seeing those trends continue with quite a strong economy. I'm sorry, I can't comment on that exact.
Right. No. Understood. I guess I just wanted to get a bigger picture of the degree of nervousness that's out there before the jobs report on Friday. So let's just stay with the jobs report on Friday, because for the most part, the numbers don't look terrible, right? The consensus estimate is for 165,000 jobs added after 114,000 jobs were added in the month of July. Unemployment is seen declining to 4.2% from 4.3%. Where are the weak links in this jobs report going to be?
So I think you're exactly right. What we're looking at is a continuation. Those kinds consensus numbers expecting are very much in line with what we've seen over the last year, about 164,000.
Sorry, just
month. Again, that's starting from population growth.
All right, hang on one
And so I
second
think
here.
that there
We're having
is-
some issues with Elisa's audio. We're going to try to get that sorted out here. Of course, as we push ahead, really to what could be one of the marquee events of the week, that monthly jobs report number on Friday. I mean, if you look at the numbers themselves, at least based on what economists are expecting, is relatively in line with some of the data that we've gotten over the past few monthly jobs report numbers. And you look at that sort of rolling trend here, we're still kind of creating 180, 200,000 jobs a month, which under any other circumstance would be considered healthy. You still have an unemployment rate down in the 4s. That's still healthy here. So even if you do get maybe an uptick in the unemployment rate, a downtick in the actual payrolls numbers here, that's not necessarily a run for the hills kind of moment, is it?
No, it's not. And I look at the estimates that are out there for the August jobs report, and it really ranges the gamut, right? It goes from 100,000, that's the low point, to 208,000. So it feels like economists are kind of throwing a dart in the dark a little bit here. Stuart Pott of Bloomberg Economics was on earlier today, and he did say that for the most part, he was starting to see people take down their estimates a little bit, you know, and that's been happening over the last couple of weeks. So we're starting to see that revision among economists themselves.
And I really want to know how this folds in at all to what the Fed actually not only does on September 18th, but more importantly, what it communicates going forward here. And I know we have a big asterisk that one data point isn't going to necessarily shift it. But when you look at it in aggregate here, has it really going to change the narrative? I mean, unless it's obviously a huge miss or a huge beat, that could change the narrative. But if it's relatively in line around the contours, then why would the Fed react to that?
Right, right. Well, I mean, the investors have moved way ahead in terms of what they think the Fed is going to do, right?
As they tend to do.
As they tend to do. We've seen this before, and the Fed has not done anything yet. It hasn't even cut rates, while people are pricing in 200 basis points of cuts over the next 2 years. Let's take a look at how markets closed on the day, because it's really hard to overstate the amount of damage that was done in names like NVIDIA and the chip makers. The S&P 500 losing 2%. The VIX shooting up. It got to 21. Of course, this was the biggest decline since August 5th. And on August 5th, the VIX got to, 65? It didn't get anywhere close to that level, but certainly there's elevated volatility, this elevated sense of, things may go haywire.
And I thought it was interesting, too. I mean, when you look at some of the notes that came out to start the month here, a lot of people were talking about expect that elevated volatility to get even more elevated here. There was a great note out by the fixed income head over at T. Rowe Price. He was specifically concerned about what's going on with the Japanese yen and the carry trade. Jeff Currie brought this up a little bit early on the program here, too, that a lot of what's ailing the U.S. market right now is actually sort of coming not from inside the house, but from outside the house. It's a lot of foreign investors who are repositioning what they're in and what they're out of, and that's having a big impact here on the price action you see inside the U.S.
Yeah, that yen carry trade is not complete yet, and people continue to make moves all around, and you could see that in global commodities like copper, like oil. This is the close on Bloomberg.
All right, welcome back. We should point out here in the after hours trade, still keeping an eye on NVIDIA. Those shares now down about 2% on that news we read to you earlier. But we do want to talk about one of the big stocks that got caught up during the cash session in the sell-off, and that was X. No, not that X, the original X, U.S. Steel. The shares having their worst days since March, despite Vice President Kamala Harris echoing President Biden's calls to keep U.S. Steel in America.
U.S. Steel is an historic American company, and it is vital for our nation to maintain strong American steel companies, and I couldn't agree more with President Biden. U.S. Steel should remain American-owned and American-operated.
The rhetoric from Kamala Harris echoing rhetoric from Joe Biden, echoing rhetoric from Donald Trump, and that is the reason why the shares are down. That deal, Biden upon Steel, not looking good. Bloomberg Balance of Power co-host Kailey Leinz joining us right now in Washington for more on this. And I mean, look, we found unity in Washington, Kailey. Everyone hates this deal.
Yeah, I guess there are still some things that are bipartisan, Romaine, because you're exactly right. If you are U.S. Steel and Nippon trying to get this deal through, the fact of the matter is now it is firm on the record. Both of the presidential candidates who could end up in the Oval Office come January are not in favor of this deal getting done. Donald Trump, of course, has called outright to block it. Joe Biden hasn't yet hit that line. He's waiting for the CFIUS review that is underway. The Treasury Department is looking at this deal to wrap up first. So it's unclear whether or not this is something that could be resolved in Biden's term or will be in the hands of either a Kamala Harris or a Donald Trump presidency to deal with. But by and large, this is, of course, really about unions, steelworkers unions specifically. It is not a coincidence that Harris was making these remarks in Pittsburgh on Labor Day with Joe Biden by her side, as Pennsylvania is, of course, one of those critical swing states that she really needs to win if she wants to secure the presidency. And the steel vote, the steel worker vote in particular, is going to be pivotal in that. I would note that that doesn't just go for the presidential race. The senators in Pennsylvania, including Bob Casey, who is a vulnerable incumbent in this cycle, is against the deal, as are the senators in Ohio, including, of course, Senator J.D. Vance, who is Donald Trump's running mate on the Republican ticket.
Yeah, so clearly both parties in favor of keeping U.S. Steel away from Nippon Steel. And we should mention that the Pittsburgh rally also included members of the United Steelworkers and other major unions as well. So in making those comments today, Kamala Harris really made clear to articulate a position that was very much aligned with Joe Biden. Is there anything else on any other issues where she's been as forthright in making clear that she is exactly on the same page as Joe Biden? Because so far she's done this, I guess some people would say, admirable job of hewing close to the Biden administration's overall stance, but separating herself just a little bit to make clear that she is the change candidate.
Well, Scarlett, she certainly isn't trying to create really any degree of separation when it comes to labor specifically. Joe Biden, of course, has touted himself as the most pro-union president in American history. She characterized that yesterday as the most pro-union administration that she said she's been happy to be part of. So she clearly is trying to play up the labor ties to the exact same extent as the president she served for the last 3.5 years. That said, in terms of other economic issues, that's where you're starting to see a little bit more distinction being made. Kamala Harris, of course, in her first sit-down interview since becoming the Democratic nominee last week on CNN, did call Bidenomics good work. She said that she is proud of the work that has been done when it comes to infrastructure, the CHIPS Act, the Inflation Reduction Act, but that she does recognize there is more work to do. And it's in that kind of future work to do area that you maybe see some distinctions with what she's proposed when it comes to housing and the like. And of course, on non-domestic issues, geopolitics in particular, she's been much more vocal in criticizing the Netanyahu administration and advocating more for Palestinian sympathizing views than Joe Biden has been when we look at what's happening with the war in Gaza, which, of course, has been freshly in the news given the deaths of 6 hostages over the weekend.
All right. I do want to go back to the labor issue and more specifically here, some of these antitrust issues, Kailey, because one of the big bugaboos for investors has been, at least over the last 4 years, has been you had an administration with the DOJ, with an FTC that was much more aggressive here in policing these deals, maybe not necessarily suing, but certainly sort of making it clear that there were going to be a lot more scrutinous of this. Is there any sense here that if we get a new, or if we get a Kamala Harris administration, I should say, forgive the Freudian slip there, but if we get a Kamala Harris administration here, the idea that we are still going to see that same sort of strength, that same sort of push to try to push back on any and every deal that I guess they feel somehow could be damaging to the workers or their economy or whatever the argument is.
Well, there's been no indication of that, Romaine. In fact, one of the things that Kamala Harris touts frequently about her bio is her work as the attorney general in California, going after specific companies. So there's been no suggestion that she is going to be less pro-competitive than this Biden administration has been, because you're exactly right. Obviously, if it's the DOJ, the FTC, what have you, they have really been pushing for competition. And certainly are seeing more evidence of that with the subpoenas that just hit NVIDIA from the DOJ as they look into whether or not they violated antitrust rules when it comes to the AI chips that they are making. I would just note, though, that might not just be true in a potential Kamala Harris administration. The Republican ticket, specifically Senator J.D. Vance, has also been very pro-competitive. He has actually praised Leveille, the commissioner, the chair of the FTC, of course, in the past. So there is one of those areas where there doesn't actually seem to be too much distinction between where the Democratic and Republican tickets are, as they kind of are espousing some similar populist ideas. And that kind of antitrust effort is one area where we see a little bit of overlap on the Venn diagram.
All right. Fantastic context there. Kailey Leinz, co-host of Balance of Power. Be sure to tune in to her and Joe Matthew at the top of the next hour. Still ahead, what investors need to watch for tomorrow. And it does include earnings from a retailer as well as a chip company. This is Bloomberg.
It's Jobs Day, and Bloomberg has the report under surveillance.
It's from super hot to solid.
This is normal.
I think people underestimate the behavioral aspects when it comes to the labor market.
This Friday, Jonathan, Lisa, Anne-Marie, and Mike will bring you crucial data and expert analysis at terminal speed.
So what is bad on September 6th?
Nobody really has a full answer on it.
I don't know what counts as good news these days.
It's a big debate.
The August Jobs Report, Friday on Bloomberg.
A brutal day if you're long U.S. stocks, specifically semiconductor stocks, specifically NVIDIA, because the AI chipmaker tumbled 9.5%, wiping out almost $280 billion in market value. And of course, after the close, we told you about the breaking news in which NVIDIA has gotten a DOJ subpoena in an escalating antitrust probe. Bloomberg's Sara Forden joins us now from Washington. Sara, can you tell us a little bit more about specifically what action the DOJ is requesting right now from NVIDIA?
So we reported, based on our sources, that the DOJ has sent subpoenas to NVIDIA and several other companies, including customers and suppliers. They're looking for information about whether NVIDIA is violating antitrust laws. And the focus is really about how the company is doling out access to these, much-needed chips that are fueling the explosion in AI computing.
Is NVIDIA the only company that was subpoenaed, Sara?
No, there are more companies, the NVIDIA and customers and suppliers. So they're looking at whether NVIDIA is doing something called bundling or tying, where they say, only people who are just exclusively using our chips are going to get chips, which then cuts off the supply of these chips to other companies in the market that also need them to compete. So the dynamic here is by withholding or selectively doling out access to these chips, are they hurting competition in this, surging market for AI?
Sorry, let me reframe that question, Sara. Do we know the other companies that were actually subpoenaed?
Do we know? No, we don't have the names of the other companies.
Okay, so you are the legal team leader for us in Washington, D.C. How long do these investigations typically take before further action is expected? I mean, they subpoenaed NVIDIA, but this could be a long while before NVIDIA responds, or could this move very quickly?
So these investigations typically can take months. They can be very drawn out. What we're reporting on today is really an escalation in the case, because these subpoenas are legal demands for information that the companies must respond to. And so that's a sign that the DOJ might be building a case, because they can take the evidence that they gather from these subpoenas into court, and they can use them to file a formal complaint against the company. Which would be an antitrust complaint accusing the company of abusing its market dominance.
Is there, based on what we know, our reporting, Sara, and we should point out this is all people familiar with the situation our reporters have spoken to, but is there any link that we know of to that initial investigation that we reported about that involved OpenAI and Microsoft, Anthropic, and some of those other firms that I think we first reported back in January of this year?
I mean, the antitrust agencies are looking very closely at various aspects of the AI market, including investments in AI and whether there's anti-competitive issues there. But our understanding is that this NVIDIA probe is specifically about how they are designating the supply of chips to other companies in the market.
In our story, we make clear that the DOJ's San Francisco office is taking the lead running the inquiry. What does that mean to someone like you based in D.C., that you have the San Francisco branch really taking point on this?
Yes, the DOJ has field offices all over the country. They have antitrust enforcers in these different offices. And so these would be the real experts in Silicon Valley, in the tech companies, in the marketplace.
All right, Sara Forden on the ground there in Washington, D.C., helping us walk through, of course, the big headline crossing the Bloomberg terminal, a DOJ subpoena for NVIDIA, as well as some of its customers and suppliers, an antitrust probe here into how that company is doling out those chips. We should point out in the after-hour trade, those shares down about 2%, although they fell a lot more in the cash session. So we'll be interesting to see what happens when we come back tomorrow morning. There's going to be a lot of other things also that the market will have to parse tomorrow morning, including some earnings in the retail space.
Yeah, we've got Dick's Sporting Goods reporting before the open, along with Dollar Tree, which will be really interesting given the commentary that Dollar General CEO gave us about how their customer base just was not spending. They're really concerned about inflation and the economic outlook, and we're really, really tightening their purses.
We're also going to get another read on the consumer after the market with Casey's General Stores, and maybe a read on AI and tech with Hewlett-Packard Enterprises reporting. And then 9:45 a.m., you get a big rate decision.
Yeah, not the Fed. So hold your horses, everyone. Yeah, we're talking about the Bank of Canada coming out with the rate decision. And right now, the rate is at 4.5%.
All right, that's economic data. Also tomorrow, trade balance, I don't know. Does that really move the market? But we got some other things that could.
Yeah, JOLTS is coming out tomorrow morning before the open, and durable goods, which tends to be a volatile number, along with factory orders on the heels of a pretty disappointing ISM manufacturing report.
2 p.m. Washington time. The big number, the big headline coming out. The Fed Beige Book.
Are there numbers in there?
Coming out. I don't know. There's something in there. It's mostly anecdotal, but we'll read it and parse through it anyway, and we'll bring you all of any news that breaks out of that right here on The Close. Stick around. Balance of Power coming up next, right at the top of the hour. This is Bloomberg.